All right. Good day, everyone. And I want to welcome you to episode 26 of In Conversation with Convergence. And as many of you know who've been listening for really now over 2 years, we meet with clients and we discuss, on a very regular basis, some of the top issues facing the industry. I am joined with by two great guests today, and I want to welcome them. First with us is Kathy Malone, and Kathy is a senior managing director responsible for really regulatory and compliance consulting at IQEQ, and Libby Toudouze, who's also a managing director and head of ESG for the United States for IQEQ. So I want to welcome you both. Thank you for joining Convergence today.
Thanks for having us.
Kathy, maybe starting with you, it'd be great to give our audience a little background on yourself and kind of your pedigree and I know it, but your pedigree and then kind of your role at IQEQ.
Sure. Thanks, George, and thanks for having us today. I'm a senior managing director, as you mentioned, at IQEQ. I started my career at FINRA and then at the SEC for a long time doing examinations in the broker-dealer and RIA space, and then moved over consulting about 12 years ago. So been with a number of firms and now here. I head up the staff for the compliance team, and there's about 120 of us at IQEQ, and we focus on meeting all our clients' regulatory needs, so both from a registration and an ongoing purposes.
Yeah, and thank you. And what I think is interesting about that, just so you know, your IQEQ as a fund administrator has really been one of the first movers in the market with coupling, compliance with fund admin, right? And now we're seeing that a little more of a trend in the market. But I think you guys had, a great vision on, bringing that to your clients very early on. So welcome. And Libby.
Sure. Yeah, Libby Toudouze. I've spent about 30 years in the investment business, primarily on the buy side. I've been a trader, an analyst, and the last 20 years, a portfolio manager for various energy infrastructure portfolios. And I joined IQEQ to help develop the ESG offering in the U.S. Now, keep in mind, this firm's been around for a while. We've had an ESG offering for a decade around the world, but we hadn't really formalized our offering in the U.S. And I also work on some of the firm's strategic initiatives with clients here in North America.
Yeah, well, I look forward to talking a little bit about ESG. A lot of people know the acronym. I'm not sure everybody knows what it really stands for, and it kind of means a lot of things to a lot of different things to a lot of people. So it'll be interesting to talk about that. I thought, Libby, maybe we could start with just a brief overview of kind of IQEQ for our audience. There may be people who are familiar with your firm and others that maybe aren't. So kind of a thumbnail on the firm would be a great way to start today before we get into the kind of the meat and potatoes.
Okay, sure. So IQEQ is a global service firm to the asset management industry. And as you mentioned earlier, we offer a very broad array of services around the world. And the IQEQ is interesting because it stands for our ability to have the rare combination of being able to have technical expertise. Kathy talked about she actually worked at FINRA, and a deep understanding of our client because we have so many people that have been in the position of the client. So that's where the name came from. And the firm's made up of people with extensive investment experience, buy and sell side, to people that come from global companies, investment funds, family offices, and those are all of the clients we serve. Yeah. A range of services, everything from compliance, admin, tax, cyber IT, and ESG, and several other specialties.
Yeah, well, thank you. And listen, we've seen a real, major entrance into the $35 trillion alternative market in the U.S. over the last few years from the European fund administrators, right? And as when we talked with Kathy about really the vision of kind of getting in the compliance world early, I think obviously made a lot of sense. But, we've seen, Apex and Altradamus and JTC and Aztec and Crestbridge, and you can go right down the list, all trying to make different inroads in the U.S. Thank you for that overview. What I wanted to go through was maybe for each of you, kind of what your 23 agenda is, right? When you think about it, and then we'll get into some real detail, but maybe at a high level, Kathy, we could start with you on the compliance front. Kind of your 23 priorities. Obviously, I don't think we've ever seen the SEC busier. 53 rules up for discussion. I saw something actually you guys put out that said in 22, I think there were a record 4.2 billion in fines, right? So curious what you think with your compliance and regulatory hat on, what the big agenda for 23 is for the firm.
Yeah. So it's actually interesting when you start to dig into that number a little more, that 4.2, there wasn't more actions brought. It was just that the penalties were increased significantly over past years. So we look at certain rules which really never got a lot of attention, or at least as far as fines go. So like record keeping rules, for instance. Yes, there's record keeping rules with the SEC, but the fines associated with them are probably pretty small and it had to be pretty egregious. The SEC has changed its tactic on that, and they said, no, these actually are egregious violations, especially if it's a widespread case of this, of not retaining emails, let's say. And we saw really high profile cases with that as well. JP Morgan, amongst others, fined large amounts of money for not archiving business communications, including texts and other messaging apps, right? So we're just seeing kind of a different emphasis on different rules. And so that number, yes, it's larger, but the number of actions were the same. But it's interesting for our clients as takeaways because we don't want those things to be seen as minor infractions, right? Or
Right.
Things that we can kind of assume some sort of business risk with. So it's left us with that. So an emphasis on making sure that we are up to date on the exam priorities as well, right? SEC comes out every year and we need to follow up and make sure that we're taking those priorities and implementing them for our clients on a risk-based approach throughout the year. So we're really focused. We take those and we focus on them heavily. We also just are trying to obviously be proactive. Silicon Valley Bank, great example. A lot of our clients using them as a custodian, being there for the clients and making sure that we are being as helpful as possible and as proactive as possible. Super busy day for everyone, for us included, and so we were really taking a proactive approach when it came to things like that. So those are just a few things that have come up recently and we'll continue to work on.
Kathy, what do you think when you look at your clients, right? What do you think they worry about most right now? From a compliance perspective, like what's kind of the number one theme you see?
It's hard. I mean, I guess I could break it down by like type, right? Or industry type or strategy, right? So obviously our clients that are in crypto or digital assets, they are very focused on custody. And particularly there's a proposed custody rule that's sitting out there right now that would have major implications for them. So with those types of clients focusing, trying to think about how we would address, if we could, address those things that the proposed rule has asked that they do now. So that's been a big focus for that, I think, for our crypto clients. And just in general, right, you have with Gensler there as the commissioner, he is very focused on that asset class, right? He has experience in it and I think wants to bring some regulatory framework to it. So they're being more getting hit with examinations more frequently than some of our other clients. So
yeah, how about the vendor rule, right? The one where people have to really take a hard look at and justify, right? Maybe and document where they're doing business and maybe why, right?
Mm-hmm.
That's going to me. We have a lot of views on that, which I'll share with you. But are you seeing that? Are your clients talking about that?
I mean, we've started talking about it a little bit. The good news is that most of our clients do something right now, right? They are doing initial and ongoing diligence. That's been for years now. The SEC has requested and asked for an exam during examinations. And so we have worked with them to implement some sort of process around reviewing on an ongoing basis. This rule makes it very specific on the types of questions you need to ask, the types of documents you need to gather. And so I think from their standpoint, from the compliance department standpoint, and most of our clients, it's going to require extra time and documentation for sure. And so good news, they have something. Bad news is that it's going to be more time intensive.
Yeah, I mean, I think where that gets interesting too, Kathy, from our perspective, is if you start to get into the discussion of best fit, right? Meaning, and we would define best fit as what kind of book of business does that fund administrator have, for example, or does that prime broker have, or that custodian have, right? And can somebody who's managing a hedge fund throw their business to a private equity administrator, right? And document that that's a good decision, right? Mm-hmm. I don't know where you come out on that a little bit because I think, listen, there's no consolidation in this industry in terms of service providers, right? There's over 600 fund administrators, 300 prime brokers, 1,400 custodians, 540 audit firms, believe it or not, right? And when you start getting into this best fit, one of our views is going to be that it's going to be very hard for service providers maybe to pivot to new services and new businesses because they may not be able to get those clients to enable them to justify a decision to go with them, right? So that PE administrator that's maybe all of a sudden looking at the VC or the real estate market for the first time, right? How does this rule impact their ability to grow or build a business like that? So I'm curious what you think about just best fit.
Yeah, I mean, it's obviously going to be somewhat up to interpretation, right? And there's a gray area there with all SEC rules, basically. I mean, I think that it can be. I think there's going to be a reasonable basis approach. And I think like with most rules, the SEC will do some sort of sweep exam and then come back and say, this is what we found issues with the new rule and the implementation, basically saying, this is your warning, put in place what we think, would be better practices.
Right.
So I think we can take a little bit of comfort in that. I do think that, having the documentation to support whatever best fit means for the firm, there's no exact criteria here, right? So whatever best fit means for the firm, and we'll be working with our clients to make sure that the documentation kind of.
Yeah. I mean, I think your point on interpretation is a good one, right? Like, the SEC, for example, says, amend your ADV when you have a material change in the firm, but doesn't necessarily define material change, right? And we have a view on what those are because we look at what changes the most, right? So I agree with you. I think that as that rule rolls out and people start to adopt it, I think it'll start to firm up a bit, over time. Okay, thank you. That's good. Libby, let's go to ESG. I'd love to hear from your point of view how you think about ESG. What are the trends you're seeing in the market right now, and then really the client issues and the solutions, right? That IQEQ is kind of bringing to your client base.
Sure. Yeah. The challenge with ESG is the lack of standardization. Compliance fits in a box. There are things you can do, things that you shouldn't do. ESG is in the early stages, as evidenced by the fact that we don't have any disclosure rules today in the U.S. There are best practices, but I think there's a challenge for people to really understand what ESG is. They're risk factors. They tend to be qualitative risk factors, but it's not a social agenda or an environmental agenda. And I think that's where some of the confusion is. In talking to the different managers, we have some that say, hey, my job is to deliver the best returns. That's it. Well, to deliver the best returns, you would have to understand all of the risks, qualitative and quantitative. So if you're not assessing some of these ESG risks that are relevant material to your investments, then you're mispricing risk. So, and once they begin to think of it that way instead of a social or environmental agenda, they begin to understand that it does make sense. They're actually already evaluating many of these risk factors. They just haven't formalized that they're doing that.
Yeah, packaging it as an ESG risk, right? And also kind of at the end of the day, certain managers are going to have to adopt it, whether they like it or not, if they're going to pursue certain allocations, right, in the world. How are you? So what are you? Talk to us a little bit about your product, right, and what are you really doing for clients? That to me would be interesting to talk about.
Sure. We have a group of 25 plus people around the world that have 2 decades of experience working with asset managers, banks, insurance companies, large corporations in developing their ESG strategy. The ESG strategy is different for everybody because it's driven by the obligations and mandates of your stakeholders. And so there's a lot of variability. What we do is we offer everything from basic build out to ongoing consultation. Again, the ever-changing landscape in the United States means that you've got to be up to speed with not only best practices, what the SEC is thinking, what things that you as a firm need to be careful of. So we help clients with that. If you want to become a signatory, we do a lot of different project work to help you align to certain frameworks. Again,
Right.
there are multiple frameworks. So depending on what type of strategy you have, one framework may be better to align to than another. And so it's really just helping an advisory service, to help them in every aspect as their ESG strategy evolves.
Yeah. How have you found? I think you made an interesting point about kind of the mindset and the way you have to look at it. It's not a social agenda, right? Are you finding people are making that shift, or is it kind of slowly but surely?
So we have people in the same week. I can talk to one person that has the view of, hey, I'm not doing this, but my LPs are forcing me. So what's the least I can do? To people who said, look, this is a part of our culture. We think it makes sense. We think it adds value to our portfolio. And so we want to do everything we can. What are the best practices? We want to lead the peer group. So it's really all over the board.
Yeah.
The bulk of the work we're doing right now is the basic build out, which would include helping them develop an ESG policy that protects them from greenwashing or other things the SEC looks out, a processes and protocol memo, and maybe some KPIs that focus on ESG, and helping them as a firm to make sure there's consistency in what they say they're going to do in relation to ESG, how they're doing it, and that they can document that they actually do it. And that's how, again, similar to compliance, how we help protect them.
Yeah. And I mean, I'm assuming from everything I read that kind of size matters. Like it seems to me that some of the biggest asset managers are leading the charge. I mean, are you seeing that in general, your point of view?
Yes, absolutely. And, they have 10 to 25 person teams focused on ESG. What they don't have is a way to properly manage the data. And that's something that's a big priority for IQEQ across the board is data efficiency, technology, and data warehousing. And ESG, is about data, just like most other areas are. And so being able to identify the data, being able to monitor it, and being able to report on it are what LPs need. And that is irrespective of size.
Right.
As I said, the big guys have a lot of people focused on their ESG. They have all their foundational documents in place. They're usually signatories, but they're still challenged. They're keeping data in an Excel spreadsheet. They're not sure what data they should do. So that's an area where we have a proprietary technology to help them
Yeah.
with the data monitoring.
Yeah. How about the whole concept? Out there, I see lots of people, and we do this, right? Kind of trying to standardize and score kind of ESG, meaning, based on different methodologies, right? We're seeing people trying to develop, being able to assign an ESG score to asset managers, right? Whether they're participating, compliant, there might be a whole list of things they check. What are you seeing relative to that discussion?
Yeah, there are a lot of people competing to become that standard, right? Either of a rating or a verification. The challenge is you don't have one framework that everybody adheres to. So you've got multiple frameworks, and then there is not an accepted rating system so you've got multiple different rating systems. And then within firms, again, we're dealing with qualitative data. That's what most of the ESG data is.
Right.
Within firms, they're having to take that qualitative data and put it into some type of quantitative and adjust whether it's revenues or expenses or whatever they need to, so that they can show how it will, impact a company's valuation. So we're really early in the stage of that. I've heard that the big accounting firms have tried to work together to develop, but we don't have anything yet that is in the, at the forefront and accepted.
Yeah. I mean, listen, where I personally think it's going to go, and we've done this, Convergence has done this with a lot of qualitative data, is we look at kind of consistent and inconsistent practices across the industry in terms of like a benchmark, right? And it might be the way this gets solved because I think at some point, we can tell a compliance person, Kathy, like you, that, hey, the average advisor has 3 affiliates, right? And why does this person have 69, right? You might want to look at that if you're doing kind of compliance and risk. So there's just inconsistent practice, right? So I think, Libby, that's maybe where it's going to go. We'll see. But I think once there's enough players at the table, you'll start to be able to look at standard ESG practices and start to develop like what's an industry norm, and then maybe you start to benchmark. Is my guess. But
yeah, we need to understand how really to quantify the data first. So
right.
Before and what data. Again, it's what's material and relevant to your investments, and that can differ greatly, obviously, across industry and strategy.
Yeah. All right. Well, listen, I'm going to finish up with one last 2-part question for both of you, and I'll start with you, Kathy. Kind of from your purview, your compliance and regulatory purview, what do you see as the biggest opportunity for you, right, in your business this year? And then on the flip of that, what's probably the biggest challenge that you think you're going to face in the market this year? And then Libby will do the same on kind of the ESG front. So, Kathy.
Yeah, opportunities. We see a lot of our VC clients no longer being able to avail themselves of the exemption. So having to come over to registration land for a variety of reasons. There's a lot of secondary activity. There has been for the past 2 years or so. And so, they just find themselves needing to be registered and walking them through that process. Being exempt is very easy as far as compliance and regulatory obligations. And so when they move they need a lot of handholding, which is where we come in. And I think we specialize as far as they're bringing them over and making sure that they have everything they need and setting up their program correctly. So we're seeing a lot of influx of that. We also have a broker-dealer practice here that I lead, and so we are seeing more broker-dealers. Again, usually a private fund client who wants to open a broker-dealer for transaction-based comp or another reason, out there in the market again. So we're seeing activity there as well. I think it's interesting that people have become more open to the idea of outsourcing their CCO as well. So we don't want to, if it's the right client, we don't want to say that we won't do that. And so we've developed a pretty robust outsourced CCO program as far as internal controls go, and how we work with the client to make sure that, both sides are comfortable with that relationship. So we've seen, I think the pandemic had a lot to do with it, and just a lot of remote working, that became something firms were okay with. And our law firm colleagues also said, you should offer it in the right circumstances, and they were signing off on it for a lot of our clients. So I think that helped.
Yeah.
So those are things I see as real opportunities for us.
What do you see on the flip? What's the biggest challenge or two you see in the market for you?
Yeah, challenges, I guess, launches just generally, right? We're seeing it's either taking longer to fundraise the assets they need to register. Hedge fund launches in general, just we haven't seen as much activity. So again, those are just kind of market driven things.
Yeah.
They're cyclical in nature and will come back around. So
yeah. Well, listen, I think your point on outsourcing CCO is interesting. We probably have seen more fractional CCO firms emerge, right, in the last couple of years than we've ever seen. We're seeing advisors kind of want to wrap together as many services as they can, right? And not have 8 services and go hire 8 service providers. So, we were always very impressed with, kind of the Blue River, the Constellation work, right? That you guys did early. It really led the pack, I think, for what a lot of admins are thinking about, right? Libby, how about on your front, on the ESG front, in terms of opportunities and challenges?
Yeah. So as far as opportunities, this applies to every one of our clients, and the majority of them, especially when you're talking about the small and mid-sized managers, have just not even put the basic building blocks in place. It typically comes when they're ready to go to market to raise a fund, and they realize that's a box they need to check. Yeah. So there's a large universe of people to begin to build a relationship with, and that will be with us for their ESG for a long time. We understand the outsourcing business. There are a ton of firms that have popped up in the last 5 years. Every law firm has a consulting piece. The Big Four have a consulting piece, and they're super expensive. So we are, again, a very cost-effective solution to handle your ESG. And ESG and compliance are very close. So we can offer a solution where your compliance and ESG teams are working together.
Yeah.
And I think that's a nice edge for people.
Yeah, no, I like that.
Yeah, because we've been doing it for 20 years around the world, which the rest of the world and managers across the globe have been ahead of us. We've got the resources and the experience and can deliver that to our clients.
Yeah. How about challenges? What do you think? Is it back to standardization and a common view, or what do you think beyond that?
Yeah, so I think you can look at challenges 2 ways. The first challenge is ESG tends to be low on a lot of people's list of things, especially with the market volatility, and Kathy touched on the banking issues and other issues that they are, either fire drills or just higher priority they have to focus on. So, and then, once they are ready to move, then it touches, as you said, George, on, okay, how, what are the best practices that our firm, based on what we do, need to employ. And so that it takes time to work with them on that.
Yep, terrific. Well, listen, I want to thank you both for joining us. I learned a lot. It's I really like the focus of each of you relative to this big global firm known as a fund administrator is a lot more than that, and the fact that you the point you made about kind of the closeness of compliance and ESG, I think really is a big market advantage. So thank you. Well, I want to thank IQEQ and especially Libby and Kathy again. I thought it was a terrific conversation, and they're a great client. So thank you both. As always, I kind of just finish up with a little discussion around the league tables for service providers and the distribution of new business. So let me start on the fund administrator front. So year over year, from really March to March 22 to 23, we saw assets under administration decline about 2.25%, and that's very much in line with the marketplace. But the distribution is very interesting. Administrators 1 through 5 were down a little over 6%, so almost three times the market. Admins 6 to 10, though, were up almost 5%, so a great performance. And admins 11 to 25 were up close to 4%, and then admins 26 to 600 were down about 4%. So we really saw that admin growth kind of in the rankings of admin 6 to about 25. On the auditor front, that same asset growth minus a little over 2% year over year, and this distribution continues, and I think it's even more amplified this month. So the big four down almost 3% in assets. Auditors 5 to 10, though, up 41%, which is just stellar performance by auditors 5 to 10. And then 11 to 25 up 10%. And again, this is in a market that was down 2. So again, we really saw the growth here down market, auditors 5 to 25. Moving to custodians, right? That same type of asset lack of growth. And here we saw custodians 1 to 10 pretty much flat, right? Custodians 11 to 25 up a little less than 1%. And really the growth in the custodian market was about 15% in a minus 2% market, with custodians 26 plus. So again, seeing that down market. And then lastly, prime brokers. We look at primes more from a fund perspective, and in that same period of time, we saw funds grow. And this is March 22 to 23 again. We saw funds grow almost 12%, and prime brokers 1 to 10 grew about 1%. 11 to 25 grew a little over 7%. Then all of the primes grew just about at the market, about 12%. So really what you're seeing here is the heavy hitters in each of these segments kind of holding their own, but great growth in that middle pack of the 25. So listen, I want to thank everyone for another episode of In Conversation with Convergence. My name is George Evans. Great guests with IQ-EQ this month, and we look forward to seeing you all in May. Thank you.